Douglas Burtnick, you manage a fund dedicated to North American small cap equities. In what state do we find the North American corporate world in this particular moment?
Right now, we see corporations as being quite strong. They've improved their balance sheets over time, and a lot of them have actually expended the amount of cash. Some of them have gone out of their way to borrow longer term and to lock in interest rates at these currently low levels. We like the opportunities generally in the market, but in particular, we like being really selective in the things that we invest in for our clients.
So how do you pick your companies, and what are the favorite names you have in your portfolios?
We really like to find companies that are differentiated and have something special to them. We use a very fundamental bottom-up process to select companies, and we only hold about 50 companies in our small cap strategy. Some of our favorites include a company that helps drug companies do clinical trials called Parexel. Another company called Gibraltar Industries that's in the midst of restructuring and improving its margins over time. And we like a bank in Montana that lends particularly into the agricultural sector, but will benefit from a strongish economy and has very, very good credit.
In Switzerland, small caps have outperformed large caps for a considerable time now. Is it the same in the US?
Small caps have actually underperformed large caps in the US since last summer. We see that as a great opportunity right now because they trade at a relatively small premium to the US, and if you're very selective at what you choose in the small caps, you can get a very good result, and we expect that growth rates for companies that have their own things that can affect the world will be better than for the economy as a whole.
General wisdom has it that valuations are higher in the US than in Europe. Are valuations rather an incentive, or are they prohibitive to investors?
We think that when you adjust for the difference in the types of economies between the US and Europe, that you'll find that US valuations on a sector-by-sector basis are actually somewhat similar to those in Europe, perhaps just slightly more expensive. Because of the opportunities that we see for the economy and for companies there, we think that's an okay premium, and it's not prohibitive to think about investing in the US now.
Now, in the general environment, there is the Fed. A lot of people expect a rate rise in June. How will that affect the stock markets?
Historically, the Fed only raises rates when the economy is doing well, and when companies have things going their way. The early stages of rate hikes start out with smaller companies actually outperforming larger companies, and with equity markets holding in pretty well. That continues for at least a year following, so we think this is actually a good opportunity, particularly since smaller companies have underperformed somewhat in the last few months, to see them start to outperform the larger cap counterparts.
Another topic that casts a spell on us in Europe is the American election, the presidential election. How do you think will this affect the economy and equity markets?
Well, we hope that the candidates will be fairly pragmatic in their application of economic policies. The way to get nominated for the party in the US requires candidates to be somewhat more extreme, perhaps, than what can actually be implemented in the future. So we're hopeful that we'll see more economic policy that seems to be a continuity of what we have today, rather than a radical change.
So who will win?
I think it's kind of close right now. We'll build a portfolio that actually is not particularly subject to any outcome, because we really focus on what the companies can do rather than what the macro environment provides for them.
Very good to hear. Douglas Burtnick, thank you very much for your insight.
Thank you very much, Mark. I appreciate it.